And today I wanted to talk about market concentration, which has been kind of like an ongoing talking point in financial media. And there was a really cool report. I kind of wanted to feature it and give my 2 cents on it when it comes to market concentration. Is this something you guys have ever been like concerned about or looking at?
Yeah.
I mean, we've talked about concentration of wealth and, and market concentration in the past, but we haven't spent a lot of time on it.
Talking about correlations of portfolios for sure.
Sure, that makes sense. Well, now we get to talk about it because I've been hearing it. It's been kind of like an ongoing conversation really since like end of 2023, really since we've had this really crazy rally that was predominantly driven by tech stocks and also like a handful of companies especially. And so, yeah, pretty significant divergence from the S&P compared to the equal weight version of it, which we're going to show a little bit later. And so there's this kind of like ongoing question. Obviously, a lot of people are talking about it. But does that actually have some kind of relationship to market volatility? Because I think that's the implication that a lot of people kind of like talk about this with, but is that actually measurably true, right? Does that make sense?
Yeah, Let's check it out.
Cool, let's do it. Okay, so Visual Capitalist recently reported that the top 10 stocks made up about 38% of the S&P in 2024, which is substantially higher than the long-term average that they reported, which was 24%. So significantly higher, like last year, basically. And because market concentration has been abnormally high, it's been a pretty hot conversation topic. But is there any kind of conclusive relationship between market concentration and market volatility? And today I'm going to pull up a report from this company called FS Investments that I think is pretty cool, and we're going to talk about it.
Kidoki, let's do it.
Do it.
Okay, let's go to the next slide. So right now, market's pretty concentrated in the context. Well, just actually, what does that even mean? Market concentration in the context of a market index, it really refers to the degree to which a small number of stocks make up a large share of the index's total market cap, right? So in this case, like the top 10 holdings of the S&P currently make up about 35% of the index, which is quite high. So we would call that high market concentration. And that number obviously fluctuates with time. It's a market cap weighted index. So these weights kind of change regularly. And we're going to look at like an example of how it's changed through time. But right now we're at about 35%, which is pretty high. Yeah?
Yes, most definitely.
Let's go to the next slide. So the tech sector also makes up an overwhelming percentage of the S&P. It's the largest sector, making up about 30% of the S&P, followed by financials at about 14%. So tech's about double the size of the next highest sector when it comes to this representation. And a report from 1990 to 2016 by this group called Bespoke Investment Group, they published the kind of like sector weighting of these different sectors in the S&P over time from 1990 to 2016. And they found that the tech sector weighting in the S&P peaked at about 35% in 2000. So we're kind of approaching .com levels of tech concentration, right? It's really been like creeping up since 2016, this tech exposure in the S&P. Yeah?
Sure. We'll give that to you. Sure.
I'll take it. Okay, let's go to the next slide. And as the markets sort of become more and more concentrated in a handful of companies and in one particular sector, we've actually seen a pretty noticeable market impact beginning around 2023. This sort of exceptional performance from a handful of companies, and especially in the tech sector, drove actually a pretty significant difference between the S&P 500, the cap-weighted version of it, and the equal-weighted version of it, RSP, which I like to use as a reference in terms of like how much that kind of cap weighting or those really strong performers might be driving up the index as a whole, versus like the equal weighted version of it, which attributes equal weight to the index for all the companies, right?
Okay.
Following so far? Yeah. So now here's the question. Does this higher concentration necessarily bring more market volatility? Do you guys have thoughts on that?
I would assume it does. But I don't know. I would assume it does.
Okay, let's get to the next slide.
I would think the more spread out something is, it's got to have less volatility, and the more concentrated it's got to have more volatility.
See, I thought the same thing because diversification's obviously pretty important for like individual investors, for investment portfolios. So you'd think having like less diversification in an index would yield more volatility in the index. And to understand this, there was this report from a company called FS Investments. It was called Concentration Issues, a look at the top heavy US equity market. And it included a graphic, which I showed here, of market concentration. So these are like the top 10 shares or the top 10 companies in the S&P 500 that weight in the index's market cap from 1953 to 2023. So it's a little bit outdated, but I think we can still kind of use it to gauge whether there's some kind of relationship between market concentration defined by the top 10 holdings and market volatility, looking kind of like back in time. Yeah?
Okay.
Sure, why not?
Why not? Let's take a look. The results surprised me. Let's go to the next slide. So 1953 to 1973 had the highest recorded levels of market concentration, actually significantly higher than now at its peak, but around where we're currently at, around 35%. And that occurred between 1953 to 1973. So that's kind of like the most comparable levels of like market concentration with regards to the top 10 holdings. But obviously the tech sector was not like the biggest sector. So we're just looking at it with respect to this one variable. Okay.
Okay.
Let's go to the next slide. So during this time, I decided to look at like the annualized 30-day historical volatility of the S&P because we didn't have, a VIX going back that far. So we kind of looked at the historical volatility equivalent. And what we saw was the average was about 9.77%, so around 10%. And it peaked around 37% in the 1960s. So that's kind of like, that's our baseline, going from this very high level of market concentration, where we had about 10% as our average historical volatility, and we peaked around 37%. Right. And that's kind of like, that was at very high levels of market concentration. Yeah.
Mm-hmm. Okay.
Let's go to the next slide. But now when we look at 1983 to 2000, we can compare those high levels of market concentration and the historical volatility that we saw in the market to a historically low level of market concentration. And that was around the 1980s to 2000s. We saw relatively low levels of market concentration. Let's go to the next slide. And what we see there is the average volatility in the S&P was actually higher. It was closer to 14, like 13.7%. And it peaked to nearly 70% in 1988. So during these levels of historically low market concentration, we actually saw higher volatility and a much higher spike. There were also two instances when it spiked over 40. So in the area of low concentration, just because, right, there were a bunch of other macroeconomic like factors happening then that impacted that, the concentration itself didn't, directly tie to more market volatility, at least in these two examples, which I thought was pretty interesting. It was pretty surprising, actually.
Mm-hmm.
So what's your takeaway? Your takeaway is that that's why vol is as low as it is now, because we're so concentrated?
I don't know if I'd make that claim. I would just say that there's no actual conclusive tie between market volatility and market concentration. Like, just because you have a very concentrated market does not mean that you're necessarily going to have more market volatility. I'd argue that you're probably going to have more index sensitivity to like large moves in those holdings. So if like Apple has earnings or Microsoft has earnings and it moves the index a lot, you might have specific instances of those happening. But when you look at like historical volatility long term, there isn't really a direct link between market concentration and market volatility. They don't necessarily go hand in hand, although they certainly can, right, depending on the circumstances, right?
All right, that's fair. Okay.
It's pretty cool. I was surprised.
Yeah, I'm surprised too. I mean, nothing really surprises me, but yes, I'm surprised. I'm not sure that we trade based on market concentration anyway. So, we do make sure our portfolio is not correlated, but that's not really market concentration.
It's not. I will say, though, that like a lot of the reasons why we tend to use market indices as our underlyings is because they are sort of like inherently diversified, right? They're supposed to represent the market as a whole. And when you have a more concentrated index that becomes more correlated to like potentially other, assets in your portfolio, that can result in a reduction in risk that you might not want, more position concentration than you'd probably want. So being mindful of it, I think, is important, but trading around it's a different story. Does that make sense?
Yeah,
sure does.
Let's go to the next slide. Wanted to talk briefly about the .com bubble, which is, again, it had like at its peak similar levels of tech concentration as we have right now, but the level of like top 10 holding concentration was a lot lower than it is right now. So there's not really like a one-to-one comparison that we can make historically. But if we go to the next slide, just comparing that tech concentration in the market index, you can see that the average volatility was a lot higher than the other two instances that we looked at. So that was around 20%. And a lot of that, right, .com bubble, huge acceleration in the price of the market, crash of the market, all that kind of stuff. But the peaks were actually a lot lower. So kind of take that as you will. I didn't have a really strong conclusion to gain from this. I just wanted to try to find like some kind of comparison between our current market, but there really wasn't one. Just figured we'd get questions about it.
That's kind of weird too, because I would have thought the peaks would have been higher then. But I mean, that's just because it felt like that.
Well, sure, yeah. Yeah, I think like the .com bubble, from looking at the data, it seemed like a really like not slow burn, but just like it just depreciation a little more gradually than what we saw in like 2008 over a much longer period of time. Maybe that's not true, but
yeah, it didn't feel like that, but you could be right.
I don't know. Who knows? But yeah, that's the closest kind of comparison that I could draw, but it's really not one-to-one to what we're seeing right now, because we do have high levels of holdings concentration. We're at like, 30% or 35% for the top 10 companies, and we're at a lot of tech concentration. So what we can conclude, if we go to the next slide, what we can conclude is just looking at past instances of market concentration in the top 10 holdings. There's not a clear relationship that we can draw between concentration and market volatility. They might go hand in hand, but there's just like not really a strong historical precedent for that. And we're in kind of an unusual state right now where we have, high holdings concentration and high tech concentration in one particular, like pretty emergent sector that kind of came about in the last like 20-ish years. The .com bubble was kind of the closest comparison, but I couldn't draw any strong conclusions from looking at that data just because it is so different. But hopefully this was interesting. I know market concentration, I've been seeing it come up a lot like in my feeds, and I thought the results were really surprising because I would have expected more concentration, more volatility, and we actually don't see that strong relationship historically.
I think it was very good. I think it was very compelling. You really backed it up with a lot of facts too. So great job out of you.
Facts. We love facts around here.
A lot of history.